You wake up one morning, check your bank balance. It looks the same as yesterday. Nothing feels different. But in that quiet moment, your bank has already made money from you. Not by charging you, not by warning you, not even by doing anything you can see, just by the fact that your money is sitting there. And the strange part is, this isn't a trick. It's the system working exactly as designed. Now, here's why this matters. Most people think banks are just safe places to store money, like a digital locker. You put your money in, you take it out later. Simple. But that's not what a bank really is. A bank is a business, and like any business, it needs to make money. The question is, how does it do that quietly, consistently, and at massive scale, using your money? Let's start with something basic. Imagine you deposit 10,000 rupees into your bank account. You think that money's just sitting there, waiting for you. But the moment you deposit it, something changes. That money is no longer just yours. It becomes part of the bank's pool. And the bank doesn't keep it locked away. It uses it. This is where the story begins. Banks take your deposits and lend them to someone else, maybe as a home loan, maybe as a business loan, maybe as a credit card. So your 10,000 rupees might now be helping someone buy a bike or start a shop, and that person is paying interest. Let's say 12%. Now here's the quiet detail. The bank might be giving you 2 to 3% interest on your savings, but it's charging someone else 10, 12, even 18%. That gap, that difference, is where the bank makes money. It's called the spread, and it sounds simple. But here's where it gets more interesting. The bank doesn't just lend your exact 10,000. It lends more. This is something most people never think about. Banks operate on something called fractional reserves, which basically means they don't need to keep all your money in the vault. If 100 people deposit money, the bank assumes not all of them will withdraw at the same time, so it keeps a small portion and lends out the rest. This is how banks create more money in the system, not by printing it, but by lending it into existence.
Which means your deposit isn't just being used once, it's part of a chain. Your 10,000 becomes someone else's loan. That loan gets spent. That money gets deposited again, and then loaned again and again. And every step of the way, interest is being charged. Now pause for a second. Think about what just happened. The same original money is generating profit multiple times, quietly, without you seeing any of it. But we're not done, because lending is just one side of the story. There are smaller, less obvious ways banks make money from you. Tiny things, almost invisible, like transaction fees, ATM withdrawal limits, penalty charges, late fees, foreign exchange margins. They feel small. A few rupees here, a few there, but multiply that across millions of users, and it becomes massive.
Then there's something even more subtle, your behavior. Banks track how you spend, save, and borrow. Not in a creepy movie way, but in a data-driven way. This helps them decide what to offer you. A credit card, a personal loan, a higher limit. And here's the irony. The more financially stressed you are, the more profitable you can become for the bank. Because higher risk often means higher interest. So when someone struggles to repay, the system doesn't break. It earns more. Now let's talk about something that feels almost unfair. Time. When you keep money in a savings account, you might earn 3%. Sounds okay, but inflation might be 6%. Which means even though your balance number is increasing, your actual purchasing power is decreasing. Slowly, silently. So your money is losing value, while the bank is still using it to generate profit elsewhere. This is where the gap becomes real. On one side, your money grows slowly. On the other, it's being used in faster, more aggressive ways, and you're not really part of that upside. Now zoom out. This isn't just about one person or one bank. This is a global system. Banks sit at the center of the economy. They control credit, and credit controls growth. Businesses expand because of loans. People buy homes because of loans. Governments fund projects through borrowing, which means banks are not just participants. They are gatekeepers. And the rules they operate on shape how money flows through the entire system. Now here's something most people don't realize. Banks don't need you to be rich. They need you to be active, saving, spending, borrowing,
As long as money is moving through you, they have opportunities to earn. And the system is designed to keep that movement going. Easy loans, EMIs, buy now, pay later. Convenience, speed, all of it feels helpful. And it is. But it also increases how much you interact with the system. And every interaction has a financial layer behind it. Now, let's contrast the story we're told. We're told banks are safe, reliable, necessary. And that's true. Without them, modern economies would struggle to function. But the full picture is more complex. Banks are not neutral. They are optimized for profit, which means every service, every feature, every product is designed with a business outcome in mind, not just your convenience. So when you open an account, take a loan, swipe a card, or even just leave your money sitting still, you are part of a system that is constantly working in the background, quietly calculating, quietly earning. And most of the time, you don't notice because nothing dramatic happens. No alarms, no warnings, just small, steady flows of money moving in directions you don't see. And maybe that's the most interesting part. Not that banks make money from you, but how normal it feels, how invisible it becomes. So, the next time you check your balance and everything looks the same, ask yourself something simple. If your money isn't really sitting still, then where exactly is it working for? And who is it really working for?